There's a number that should bother more people than it does. Right now, in the middle of 2026, the typical home in America sells for roughly $432,000. Not on the coasts. At the median, in the middle of the country, in the place where the rest of America actually lives. If you're renting, your average lease has crept past $1,500 and yours is going up again this fall whether you like it or not. You have probably done the math on buying more than once, at the kitchen table after work or in bed with the lights off. $54,000 a year. Maybe $8,400 in savings. A credit score in the high 600s. A student loan bill that arrives like clockwork. And a landlord who took 11 days to fix your garbage disposal and called it good service. You grew up in a house your parents bought in 2003 for $167,000, with a chain-link fence in the backyard and a sliding door that never quite closed all the way. That same house is worth $412,000 now, and you know it because you quietly check it on your phone during lunch breaks, almost like checking a stock you wish you would have bought 10 years ago. You tell yourself you are being smart. You tell people you are being patient. But patient at your current pace means another 5 years before you have a down payment on a place that might cost more by the time you actually arrive. The market does not wait for anyone. This is where most people freeze, not from a lack of intelligence, not from a lack of effort, but because their whole life has trained them to see real estate as a heavy monthly bill instead of as a machine. From the inside, those two feel surprisingly similar. They are not even close. One night around midnight you fall into a forum thread where some random stranger explains how he bought a small rental in Indianapolis in 2020 for $156,000. 5% down. Rented it out. Let the rent quietly cover the mortgage. 2 years later he pulled cash out of the equity he had built without noticing, and used it as his next down payment. You read it once and skim it. You read it twice. You read it a third time. The math is so simple it almost feels insulting. What hurts is realizing you have spent your entire life treating debt as the enemy, and here is a stranger treating it as fuel. Something shifts in your head. Not a feeling, a reframe. The first shift is this: when your savings hit zero, the problem is not the money, it is that you are still thinking like someone who pays for shelter instead of someone who sells it. The whole road opens the moment you flip that switch. You start doing research the way you used to grind through schoolwork that actually mattered to you. You learn what a cap rate really means on the street in your own city. You learn cash-on-cash return. You learn what DSCR stands for, and why lenders care about it more than your W-2 when you apply for the kind of loan that does not require you to live in the property. You learn that a polished Class A building in a wealthy zip code will give you 4.6% on price, while a tired Class B building 15 minutes down the road gives you 7.1% with far more upside. You are nowhere close to buying either. But for the first time in your adult life you actually understand the language, and you cannot buy what you cannot name. Something small happens. A coworker mentions offhand at the coffee machine that her uncle is aging out of a fourplex in a neighborhood that has been quietly turning over for 3 years, halfway between a new commuter rail stop and a hospital campus adding 600 jobs. He is asking $309,000 and wants to be done before year-end. Every unit is rented. You go see it on a Tuesday after work. You spend 4 nights running the numbers on paper, then on a spreadsheet, then on paper again because paper is honest in a way spreadsheets sometimes are not. You almost back out. Then you call and say yes. You put 20% down, $61,800. It empties your savings down to a couple $100. You feel the way people look right before they jump off cliffs, alive in a way you have not been in months. Your loan comes back at 7.4%, higher than what your coworker got on her own home, because the bank already knows you will never live in this building. Your payment is $1,690. The 4 units bring in $3,150. After taxes, insurance, and a maintenance cushion, you clear $522 a month. That is not retirement money. It is not even close. But every single month complete strangers are quietly paying down a mortgage in your name. That is a fundamentally different feeling from collecting a paycheck. You do not quit your job. You do not announce anything. You take the rent deposits and learn how to unclog a sink at 9 p.m. on a Sunday. You learn that a property manager will cost you 8 to 12% of gross rent, and that at your size you cannot afford to hand that margin away. You do it yourself. The faucet that broke on Christmas morning. The tenant who always pays 5 days late but has never missed in 3 years. The neighbor who leaves a note about the alley light. None of these are problems. They are exactly the tuition you signed up for. 18 months later, the fourplex has stepped up in value. Not dramatically, just steadily. The commuter stop opened on schedule. A coffee shop on the corner survived its first year. A brewery moved into the old print shop down the block. Your napkin says the building is worth $368,000. You have $59,000 in equity. You have saved another $11,000 from your day job. Your net worth at 29 is $70,000. 24 months ago that number was zero. The second shift. The only house that actually makes you richer while you sleep is one that someone else is paying the mortgage on. Everything else is just stuff you live inside. You call your bank and pull $32,000 of equity out through a cash-out refinance. Your payment climbs about $200. It feels wrong in your stomach in the same way emptying your savings felt wrong at the start. You understand now why it does not matter. You are not spending equity, you are moving it forward. You drop $28,000 of it on a single-family house in a suburb that has been quietly filling up with remote workers, 3 bedrooms, a fenced yard, a school district that keeps landing on those best places lists. You pay $214,000. You spend 3 months before closing making yourself a stronger borrower, paying down a card, letting hard inquiries age off, moving money into the right accounts on the right days. You learn what lenders actually look at, then you look at yourself through their eyes. Now you have 7 units across 2 buildings. Combined rent $5,710. Combined mortgages $3,360. After everything you net $1,180 a month. At 31 your holdings are around $582,000, your debt $394,000, your equity roughly $188,000. You keep driving the same car. You keep eating lunch out of the same brown bag. You have not told your parents about any of it. You have learned that the moment you start saying numbers out loud, something strange happens to people. They either want a slice or they want to lecture you about timing. You do not have time for either. You find a 20-unit building in a mid-sized city with vacancy under 4% and rents that have grown about 3% a year for 4 straight years. List price $3.1 million. Net operating income $214,000. That works out to a 6.9% return on price, meaningfully better than the national average you have been quietly tracking. You spend 6 weeks tearing the deal apart. You find a roof 2 years past its expected life, and a tenant mix heavier on short-term leases than the listing suggested. You use that to negotiate $150,000 off. You bring in a private lender you met at a meetup 2 years ago. She wants 9.5% paid quarterly. You sign over 2 of your own units as collateral. The deal closes. This is the transaction that quietly turns you from a person who owns houses into someone who runs a small real estate business. The financing is different. The insurance is different. The tenants are different. The way you wake up in the morning is different. You hire an operations person for $1,800 a month. She is worth 5 times that. The third shift. Below 5 units you are a landlord. Above that you are an operator. The day you become an operator, your decisions change. Your language changes. The way banks return your calls changes. Your portfolio now generates $11,400 a month in gross rent and clears about $3,300 net. You have crossed 5 figures in real estate income in a single calendar year. You hire a CPA who specializes in real estate investors. She walks you through Schedule E, cost segregation, the 27.5-year depreciation window for residential rentals, and how a proper study can accelerate a meaningful chunk of that through your taxes. The savings go straight into the next deal. By 34 you are holding $2.6 million in real estate, with $1.7 million in debt and $890,000 in equity. You cross $1 million in net worth. The number lands in your chest not as pride as weight. There is a real machine on your shoulders now. Other people live inside it. You hold that weight, then you get back to work. A broker calls about a 64-unit property. The developer overbuilt during the last cycle and needs liquidity. Asking $7.4 million, cap rate 6.1%, occupancy 88%. You know the market well enough to know occupancy will hit 95% within a year, if you make 2 specific operational changes the current owner has not bothered with. You cannot do this one alone. You have never syndicated anything, so you pay an attorney and spend 4 months raising money from people you have been having coffee with for years, people with capital but no time. You close. The fourth shift. The asset you pick matters less than the terms you accept to own it. Equity, cash flow, and control are 3 different things, and a lot of investors confuse them for the rest of their careers. The one you actually want is control. At 37, your portfolio is 142 units across 9 properties. Annual net operating income is $890,000, and after debt service you net $412,000 from real estate, more than your salary. You do not make a speech about it. You tell your spouse at a Tuesday dinner. She has been watching you spend every Saturday morning on the same spreadsheet for 9 years. That night the two of you sit at the kitchen table for 3 hours talking about which properties to sell, which to hold, what your leverage should look like in an environment where the cost of money has stopped being cheap. It is one of the most important conversations of your life, and it happens in a home where nothing dramatic is happening at all. You sell the fourplex you started with. Adjusted basis after years of depreciation, $73,000. You sell it for $498,000 and roll the entire thing into a 54-unit property in a market where rents are still running 16% below comparable areas. You believe the gap will close. You are buying time as much as you are buying real estate. Your net worth crosses $4 million. You expected the number to feel like an ending. It feels more like a checkpoint that arrived faster than you planned for. You start spending time with operators at a different altitude. Not celebrities. Quiet ones who own 1,000 units and never post about a single one. You watch how they think. They underwrite deals 2 years before those deals hit the market. They build relationships with sellers before sellers ever know they are ready to sell. They size positions the way serious bettors size bets, not by enthusiasm, by correlation. You raise a small fund, $11 million, from 14 investors who have watched you operate across a combined 22 years. You deploy it into 2 value-add acquisitions in adjacent markets. You bring on a full-time asset manager. The line between investor and operator has completely disappeared. You are both. The machine is no longer something you build on weekends. It is a small institution. The fifth shift. Somewhere north of $10 million in real estate holdings, your reputation becomes its own balance sheet. Brokers bring you deals before they are listed. Lenders return calls the same day. Sellers take your number over a higher number from a stranger because they have seen you close. That trust was not paid for. You accumulated it one kept promise at a time in markets nobody was watching. At 43, your portfolio is 518 units across 7 markets. Asset value $74 million. Debt $46 million. Equity $28 million. Net worth $34 million. The exact figure is known to your attorney, your CPA, and your spouse. That is it. The number is no longer the interesting part. The structure is. The velocity is. The way capital quietly compounds and creates options that did not exist a year ago, that is what is interesting now. You sit in conversations about a 240-unit ground-up development deal. You have never developed from scratch, so you bring in an institutional equity partner who takes a preferred return and hands you the development fee plus a slice of the back end. You learn more in 18 months of pre-construction than you learned in the previous 5 years combined. The entitlement phase alone is a graduate-level course in municipal politics and zoning law, and in the strange gap between what a city says it wants and what it actually approves. You lose 4 months to a planning commission vote that goes against you. You do not panic. You do not sell. You redesign. You come back. The project delivers at 96% leased within 5 months. The same city that fought you is now using your building in its economic development brochure. You do not feel vindicated. You feel focused. There is already another deal on your desk. Your annual distributions to yourself are $2.6 million. Most of it goes back into the next acquisition. You have lived in the same house for 13 years. You still drive the truck you bought in 2019. You take your family on one serious trip a year. None of this is a constraint. These are choices. That distinction is, in a very real way, the entire point. The sixth shift. Somewhere north of $50 million in real estate, you are not really an investor anymore. You are infrastructure. Cities quietly plan around you. Lenders structure products with your name on them. The market does not overlook you anymore. At 51, your portfolio is 1,640 units across 11 markets. Asset value $194 million. Equity $87 million. Net worth $114 million. You sit in a room with 7 other principals. Together you control $4.6 billion in real estate. The conversations in that room are short. The decisions are quick. The transactions move at sizes that would have felt like science fiction to the version of you who used to check listings from a rental couch at midnight. You mentor 2 people who remind you of who you were at 27. You are specific with them. You do not give them motivation. You give them math. You show them the actual numbers from your first fourplex, the $522 a month, the 7.4% rate, the terrifying clarifying feeling of handing someone the keys to a place you own. You tell them what nobody ever told you. Real estate rewards the specific. The person who studies one market, one set of fundamentals, one asset class until they know them in the dark, that person is still at the table 20 years later. The person who has been waiting for the moment to feel exactly right is still waiting tonight. And somewhere in this country right now there is a 27-year-old sitting on a couch in a rented apartment. Their rent is around $1,500. They are looking at a home priced at $432,000 and running the math that does not work. They are telling themselves they are being smart. They are waiting. The 30-year fixed is sitting at 6.41% this week. It was higher a year ago. It might be higher or lower a year from now. The market does not pause for anyone's savings account to catch up. The question is not whether the moment is perfect. The question is what the next 20 years of your life look like if you keep waiting for it to be. The machine does not run on confidence. It runs on the first small, terrifying, concrete decision. A fourplex. A phone call you almost did not make. A down payment that empties your account. After that, someone else starts paying your mortgage. After that, the math starts running in the right direction. After that, you finally understand what the word asset actually means when it belongs to you, when it was built from your own decisions, when it hums along on a Tuesday afternoon while you are doing something else entirely. The number at the top is $432,000. It almost always starts there. If this gave you anything real, hit like so the algorithm shows it to the next person who needs to hear it, drop a comment with your own city or the first market you would actually study, and subscribe so the next one finds you when it is ready.